the mortgage calculator. Today, we're going to go through some live mortgage rates, and then we're going to talk about down payment strategies and give some different examples with some different down payment strategies here. So we will get started in just a few minutes. We are going to wait to go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So thank you to everybody tuning in on the different platforms. We put the chat up on the screen while we wait just a moment here to get started. So feel free to drop a comment in the chat. Also, feel free to ask any questions as we go through the presentation letter as well in the chat. Hope everyone's having a great week. Thank you for those that are already dropping comments in there. Ashley, Adam, I see some comments coming in. Appreciate that. We'll get started in just a moment here. A little bit of a different route we're taking today for the deep dive subject, but it's definitely going to be a good training here. So with that being said, it looks like we are live on all the different platforms. So we'll go ahead and get into it here. Remember, keep dropping comments there in the chat. And also, if you have any questions, drop them in the chat as well. So welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. What we do every day on this show is go through some live mortgage rates for a few different programs, and then we do a deep dive into a different topic every day. Our deep dive today is going to be talking about different types of down payment strategies here. So our sales manager, Jose, with 28 years of experience, is going to talk about some different routes and strategies we can go as far as the down payments go on these loans. So before we do that, though, we're going to get into our live rates. So we'll pull up our pricing tool. So Nick, if you're ready, let's pull up the pricing tool and see what the interest rates are looking like this morning.
All right, let me switch my screen and check it out. This is our pricing tool for our team of mortgage professionals. This will show us the general rates for today. It is October 17th, just after 11 a.m. Eastern. So all of our general programs are live. So we'll set up a basic scenario and compare the different programs here. If you would like a full breakdown, a full loan estimate with all the fees itemized that go into the APR, please get with our team. We have over 400 licensed loan officers in 24 states. So for the demo here, we'll set up a scenario, a $400,000 loan amount. We will set the LTV to 80% loan, 20% down payment for all our demos. We want to search for the lowest rate possible, which is typical requests these days. We will compare our programs. Conforming, conventional will be first. Then we will check out the FHA options today. And then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional options. We also have VA and USDA. VA is only for eligible vets and active service members. If you are eligible, let us know. We can quote it in just a few clicks. And same with USDA, that's only for properties that are eligible. So if you do happen to be looking for one of those eligible properties, we can quote that up, no problem. For today, we'll start with conforming conventional. We'll do a purchase, 30-year fixed, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. For all the demos, we use an estimated credit score of 760 and an estimated debt-to-income ratio here of 40%. So as we do every morning, let's check out the options. And pretty much the same as it's been this week. 7.25 rate, 2.25 discount points, 7.458 APR is the final APR there as the lowest feasible option for our borrowers today. So this is a great option if our customers qualify. Now, if our customer for any reason doesn't qualify for conventional, typically the next option we want to look at is the same scenario with an FHA program. So we'll select the FHA. Everything else will stay exactly the same as our other demo. The only thing we've edited is the loan type here. That way we can compare apples to apples on the APR across the programs. FHA does allow a little more leniency on credit issues as well as a much higher debt to income, but we're going to keep everything exactly the same so we can compare. So best option this morning for FHA, 6.5 rate, 2.5 discount points and costs, puts the final APR 7.143. It's still a touch lower than conventional, as it has been for a while. So our customers that qualify for both definitely don't overlook FHA. And our customers that must use FHA, this APR does include the upfront and yearly mortgage insurance that is required for FHA. So great options for our borrowers to lock in those FHA programs using those new MI factors. Now, where we love to help our customers is if, unfortunately, they may not qualify under FHA or conventional. Many other banks or lenders would have to deny that customer. But here at the Mortgage Calculator, we have over 5,000 other options for our customer in that case under expanded guidelines, also known as non-QM. So when we select this option, everything else will stay the same, except we have a new button pop up here for income verification. So full doc is what we use for conventional and FHA. That's 2 years of tax returns. So we'll typically select the non-QM program to use one of these alternatives, such as asset related. We did all these different types last week. So go check out those shows from last week. Business bank statement, investor programs are just for investment properties. So those aren't applicable here. Personal bank statement 12-month is the program we use for the demo. We also have RSU, stated income, VOE, 1099, P&L, and CDFI, no income options. So tons of different options here. Most popular is our 12-month personal bank statement for our self-employed borrowers. Many times it's our self-employed borrowers that when they submit 2 years of tax returns, will have various write-offs or reasons where they don't quite make enough income for the home that they're looking for and need a solution. Or they may have other issues where they don't qualify really at all. So either way, we'll solve that problem by using no tax returns at all, just their last 12 bank statements to determine a debt to income ratio, in this example of 40%, but no tax returns involved, just the cash in the bank statements. So many times our self-employed borrowers qualify for double or triple the income using that method. So let's check out the bank statement options this morning. So amazing. We have our one option here that's almost identical to conventional. So a bank statement option for 7.375 rate, 2.5 discount points and cost, final APR of 7.492. So great option here using bank statements for our borrowers that need it. Now you'll see there's a ton of different variations here, dozens if not hundreds of different ways to use bank statements. Some of these at a little bit higher rates and terms may allow us to have a bankruptcy or a foreclosure, which would otherwise cause us to not qualify, and may allow us to calculate the income a little bit differently. So tons of different options here. Please get with our team to find the best ones for you. And before we go into Jose's primary home examples, we always want to do live rates for investment properties. So our final two demos here will be for our investors. We will set up the same scenario, 80 LTV, 20% down payment. Our investors can buy the rate down a little bit lower. And we'll compare our two options for investors. We have our conforming conventional options, and we have our expanded guideline non-QM options. Remember, government programs, FHA, VA, USDA, do not work for investments. So we'll start with conforming conventional. Everything will stay exactly the same. All we've changed here is the occupancy to investment. So let's see what options we have for conventional with the investment property adjustments. All right, now this one's a little misleading, as we say every day. So this top option, amazing for our investors that want to do a conventional loan, but they're actually looking at a portfolio program. So this is not actually a typical conventional. This is not Fannie Mae, Freddie Mac. This is one of our partners that's offering the same guidelines, however, a portfolio loan that they're going to do themselves. 7.125 rate, 3.5 discount points and cost, puts the final APR at 7.375. Absolutely amazing option here using our portfolio option. Now you can see here the difference. These portfolio options, basically the same programs, but no loan level price adjustment for investment properties. That's how the rate is so much better. All of our agency rates have big adjustments. So the first agency option here for a true conventional, 7.875 rate, 4.75 discount points of cost. So that's probably a little too much there anyway. Puts the final APR at 8.167. So these options probably not even feasible to do compliantly because of the way rates are right now. conventional programs. Investment property adjustments just makes these pretty unfeasible. So this amazing portfolio option is great, as well as our other non-QM options. So for the final demo, we will check out the same scenario. And this time we will select expanded guidelines for our investment property. Now for investment property non-QM, the most popular income option is the DSCR. It's because it doesn't require any income or employment info from our borrower. Simply use the estimated rental income to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the expenses of the mortgage, the PITIA, aka the property cash flows, that's a ratio of 1.0 or higher. We also have options for under 1.0 where the property may not quite cash flow on a monthly basis. For the demo, we put 1.5, which is the highest the computer allows, so we can see all the options pop up. And the final thing we need to select is a prepayment penalty. 3 years is standard for these programs. That's what we'll use for the demo. We could select 0. That will limit the amount of options that show up and cost more. We could also select 5. That will, again, limit the amount of options that show up, but does save some money for our customer if they want to hold the property longer. 3 years is pretty standard. That is what we use for the demo. So let's check out the DSCR options today. Amazing. We're still beating conventional. It's an amazing day when DSCR is beating conventional, right? This is first time in history. It happened over the last couple months. As conventional goes crazy, it's absolutely amazing that our investors out there are offering DSCR programs for cheaper. So this option is cheaper than conventional by a long shot. This is a DSCR option for 7.625 rate, 3.5 discount points and cost, puts the final APR at 7.775. Remember our true conventional investment APR, the lowest APR option we had was 8.167. So this blows it out of the water. Even our second option for DSCR at 7.875 rate and 3.25 points still beats conventional. Absolutely amazing. 100% of investors should be using a DSCR program. Definitely when it beats conventional. Even when it doesn't beat conventional, usually about 90% of investors will typically choose a DSCR program for the flexibility. These programs, you could do 1, 2, 5, 10 loans at a time, no income, no employment, no documentation really needed. So you can do a ton of different flexible options, refinance multiple properties to buy multiple properties. And if we scroll down here, some of these at higher rates and terms may allow bankruptcies, foreclosures, may allow us to calculate income using short-term rental income. And if you've seen some of our other episodes, some of these programs allow mixed use. Some of these programs allow different property types, manufactured homes, all kinds of different variations. So tons of flexibility there. But now let's switch screens and get into our topic for today. Very different than DSCR programs. Yesterday's episode and today's episode, both, we're going to talk more about first-time home buyers. Really was yesterday's episode, which is a specific subset of kind of what we're talking about today. Down payment strategies don't necessarily have to be first-time home buyers. There are preferable programs for first-time home buyers when we're talking about different down payment strategy options. But there's all kinds of ways to seek assistance. So today we're talking about down payment strategies. Also, you could say down payment assistance. Sometimes there's closing cost assistance. Sometimes there's grants. Sometimes there's repayables. Sometimes there's non-repayable. There's many different ways to do this. We're also talking about federal programs, state programs, and local municipal programs. So tons of different ways. Jose hopefully has some more general examples of just ways to strategize how we can add different down payment programs to different loan programs, which is, again, similar topic to yesterday of first-time home buyers. Doesn't necessarily always need to be a first-time home buyer, but kind of in that same ballpark. So, Jose, I'm not sure exactly which examples you did, so I don't want to put any words in your mouth, but let's go ahead and pull up some different strategies. Not necessarily down payment assistance. I'm sure you have a couple variations. That's why we wanted to call the show Down Payment Strategies for today. So go ahead and take over if you're ready, bud.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you here this morning. Down payment assistance programs, options, strategies, definitely a topic that is in the forefront. In all the states now, they're emphasizing different down payment assistance programs. They're all feeling the squeeze and trying to figure out ways to assist more prospective homeowners to, reach their objective of owning and getting out of renting. So we have some good options out there for down payment assistance programs and strategies. Some of these are income based, the true down payment assistance type programs that are combined that we're going to go over. Not all the ones we're going to go over now, but the ones that you hear, the true DPA, are income based, right? There's going to be income limits depending on the number of occupants on the household. Uh, so keep that in mind. So let's share some options with you now. Now these are for purchases only. These aren't really geared for any type of refinance transactions here on these true DPA non-repayable options. So what I wanted to go over also was just go over a little bit of Hometown Heroes, which is a variation of a product which is very popular in all the states. Originally, this program was created for first responders, but it has been the access to the program has been opened up to first time home buyers as well as first responders. Now, Florida's program is called Hometown Heroes, but I'm sure there are different variations in the other states that are very similar, right? So, this program allows up to $35,000 or 5% of the sales price as a zero interest loan to assist with down payment, closing costs, and even for principal reduction. If you have, for example, a 100% LTV option and your closing costs are less than the amount of the assistance, you could use the remaining balance for principal reduction. Now, for this particular program, the borrower or borrowers must earn combined less than 150% of the area median income with a maximum income amount of 162,750. Anything above and beyond that, you will not qualify for the program. Borrowers must be employed full time, working at least 35 hours. First time home buyers only. This program is available and can be combined with all agency loans. So this is not an FHA only program. This is conventional USDA, VA, or FHA full doc loans. Minimum 640 credit score and one unit properties only. So this program is pretty similar to what you're going to find in a lot of municipalities, counties, states, in what would be your typical first time home buyer assistance non repayable option. They're all going to have different variations, but the whole point of that is that the loan is forgivable. Uh, well, I wouldn't say forgivable. It's there's no charge, and the loan is paid back when it is either paid off, like you sold the property, or if you stop living in the property as a primary residence. So let's get into some options here and different ideas. So this option here would be combining this Hometown Heroes DPA. And again, you can substitute the Hometown Heroes name for whatever they call it in your neck of the woods. But this one is combined with a Fannie Home Possible, excuse me, Freddie Mac Home Possible, or it could be the Fannie Home Ready, whichever one you choose, which is going to depend on your loan, right? As we were discussing, Freddie tends to favor self-employed borrowers and manufactured homes. So if you got one of those, and student loans, right? People with high student loan debts, deferred student loans, would definitely want to go Freddie rather than Fannie. They're both going to have very similar or the exact same rates. And they go up to 97%. So you would have a CLTV in this option of 102%. So here you have some lender credit options, which you can additionally combine for some more assistance there if the borrower chose that, or the borrower could choose the lower rates, which will have a cost associated with them, depending on how much money they may have available. So this is really a good way to totally try to make it a transaction with little or no money out of pocket, because you could use your $6,004, for example, down here to apply to the closing costs. You can probably apply another 2% of the DPA for the closing costs and use the other 3% for the down payment and have a totally cashless transaction. No funds to close needed for the borrower, and pretty good rates. So this is one example where we're using Freddie. Now, this is an example where we're using FHA with the hometown hero. So in this case, this is a first time home buyer option of the hometown heroes. So with FHA. So what requires it to be first time home buyers is not FHA, but hometown heroes in this case. So again, we have some good options here where you can go as low as 7.25 with an eighth of a point cost, and you can buy that down to 6.5. But again, if you're using 5% here, you're going to get 3.5% of that for your down payment, and you'll still have $7,500 left over to cover most of the closing costs. And in some markets that may have lower taxes and low insurance, that could possibly cover all your closing costs. And you'd have another transaction with no out of pocket, except for maybe the appraisal. And now in our VA option, again, the strategy here is VA is 100%. So you're going to cover your closing costs with this, and any monies you have left over, you could actually use it for principal reduction at closing. You don't have to give back the unused portion of that grant, which is essentially what this is, an interest free loan. USDA is the same. Now keep in mind this program is for one unit properties only. So for our house hackers out there, this is not the one for you. So 7.25 gives a little bit of a lender credit, and you can buy it down to 6.5%. But again, like I was mentioning, this is 100% financing. So I'm pretty sure you're not going to have $25,000 in closing costs for this property. So you will be able to cover your full closing costs and even have some principal reduction. So now let's go over some other strategies that do not require you to be a first time home buyer, but still will offer you down payment assistance. So this is one of our repayable options, which has the best pricing overall. Uh, this option at 8.25 does have a cost of 0.201 points, but it does offer 3.5% of the purchase price to be used for the transaction. They call it down payment assistance, but it could be for your closing costs, however you want to put it. It's basically $17,500 coming to the borrower to use towards their cash to close on the
And
transaction.
that says repayable. Is that repayable
Yes.
right away, Jose, or how does that one work?
Yes, this one is a 9.99% interest rate, 10 loan. It is amortized for 30 years, but it is a 10-year loan term. So at the end of 10 years, if you still own the house, it's time to refi or pay off that loan. Chances are, if they still keep the house within they're probably, the borrower probably would have refinanced way before then, and the next dip maybe a year or two down the road, home gets some extra equity in there, and they're probably going to refinance into a conventional loan, get rid of the MI, and get rid of the DPA. But it served its purpose, got you into the house. So this one, very important to note. Do
And does that
not.
affect their DTI? They have to include a DTI on
Yes,
that one. So that one is a little bit trickier. Make sure you pay attention to the DTI when you add that repayable.
absolutely. The other points to consider here is, like I mentioned, do not have to be a first time home buyer for this loan. Real important. So now let's go into some of the same or similar, but this one is forgivable. Now, the forgivable option, the pricing is not as good. So this is one of the scenarios where you really have to put down a couple of comparisons there for your borrower to review, right? Non BPA options where you could be getting a lender credit from a higher rate. And if they only need one, 1.5, I think we even have as high as almost 2% lender credit. If they have a good FICO score, then a DPA may not be needed, right? You're not going to do a DPA for nominal benefits when then you're seeing what it's actually costing, right? So in this case, now you saw that our forgivable option had a rate of I think 0.12, I mean 0.125 or something like that. Let's go back. Actually, it's a higher rate, 8.25. But in our FHA, we go back a minute to our FHA quote here, right? This one is a standard FHA loan combined with that other option. And here you're getting only a 0.125 cost for 7.125, right? Let's assume this is just a straight FHA loan, nothing going on. 7.25, 0.125. When then we go back over here to our forgivable option, and the same 7.25 is costing 2.396 to get 3%.
And it's the same FHA loan, right? It's the same first loan, right? So that's
Correct.
that's the same loan for 2 points more, guys.
Right. So what you're really getting here, net benefit, is compared to the other one, very nominal. Very nominal benefit here. Net benefit of what, 0.875 to 3%. The other one was you're only paying 0.125. So there's over a 2 point swing. So what's your net benefit here on 3%? Let's round some numbers. 1% maybe. So you gotta figure this out, because this is an additional expense out of pocket too, right? So you have a 2% higher cost to the loan. So it's a dwindling benefit here.
It's
Now,
tricky, right?
yeah,
So just make sure you pull up all the options, because there's not one size fits all for DPA, basically, right? It's very tricky to see which one's going to be the best.
Correct. Here, now we go with a 4% forgivable, and notice that the cost increases by another half a point. So now you're at 2.896 to get 4%. So what ends up happening here in these cases with the forgivable option, whether it's a 3, whether it's a 4, or the 5, right? This is the home run here. Now this one, 3.5, so it's like 3.4% more expensive than the regular FHA loan at that rate. So you're getting an extra 1.6% there. This one may, depending how you're doing it, depending what the borrower has in assets or not, sometimes these options may require some seller contribution to make up the difference. So if you're in a market with seller contribution, that's great. But if you're not, and you're doing this option, it's costing you 3.5 points. So you're going to use 3.5 points out of the five that you're getting to pay for the program. And then anything after that is your actual 1.5% DPA there. So I don't know. You got a little bit of a benefit there. But the good thing is that it is forgivable at the end. So there is a net tangible benefit here.
And it doesn't affect the DTI is the key here, correct? That's where if you're stuck with DTI, remember that, like we said, not one size fits all. If you're fighting DTI, you're going to have to go forgivable, even though it's more expensive because your DTI is your challenge. Whereas if cash is the true challenge, you're going to want to go repayable because you're going to have more flexibility that way.
And touching base on DTI, you have to read the guidelines well because these programs do have DTI overlays, right? So typically, if you're not a first-time home buyer, it's 50%. If you're a first-time home buyer, it's uh, it defaults down to 43%, but you are allowed to go to 50% if you get AUS approval at 50%. So
Also, almost all of these require counseling as well. Definitely a big thing. Almost all these require as well. So a lot of variations, a lot of tricks, a lot of tips that go out there. But make sure we use the right one, right, Jose?
correct.
All right, we do have a question here from Owen. Let's bring that up for you. So refinance or pay a balloon after 10 years. You want to touch on the repayable ones? And is the forgivable the same? Does it have a 10-year payoff period?
Well, the only catch to the forgivable is after 5 years, if the borrower has been living and is still living in the house and is up to date on his payments after 60 payments, then the loan will be forgiven. If any time there's no payment due, during the 60-month period, but if at any time during that first 60-month period, the borrower either moves out of the home as their primary residence or sells the home, then the full amount of the loan is due in full. There is no accrued interest on that either. Just a principal balance. The forgivable, excuse me, the repayable that was a forgivable option after 60 payments. After 60 months, it is forgiven if they're on time. The repayable option is not forgiven, obviously, and it is after 10 years. Whatever you owe is due. So, yes, correct. That is a balloon payment. But usually, like I was saying, 10 years is a long time, and most people will usually refinance out of that loan way before then just to take advantage of lower rates and to consolidate the two payments into one and get rid of the mortgage insurance. So you would have multiple benefits there from doing a refinance.
You could also do a FHA streamline because these are all typically FHA, or at least the ones with the repayable that you're talking about here. So at any time that who's servicing your loan could just do a streamline to wrap it all into one, typically, or to get rid of the MI totally, you'd have to go conventional, right? So a couple different ways. You could take your own power, or they'll offer you at the end of 10. They're not going to just say pay me now, right? They'll give you the strategies to refinance or do whatever you need to do because it's in their benefit as well.
All right, I don't see any other questions, so I think we can wrap it up. Remember, we do this 11 a.m. Eastern every weekday where we go through the live rates and then do a deep dive into a different topic. So we'll be back tomorrow with a new deep dive topic. Thank you, everyone, for tuning in. Thank you, Nick. Thank you, Jose. And we'll see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you. Have a great day.